Okay, welcome to Note Investing Made Easier. I'm your host, Martin Sines. And hey, Jay Humphrey, how are you, sir? And we are glad that you are joining us. We have a very special guest on today. I just have one announcement to make. The July workshop for Note Investing Fundamentals is sold out. We have we're about 60% sold out for the August workshop, so sign up if you haven't. Alex, sir, good seeing you. Ken as well. So without further ado, we are again, working towards our mission of bringing note investors that like to hide in the caves out into the open. And so we have Joshua Andrews of Paper Profits, and he's going to talk about his book. He's going to talk about he's going to talk about, what he's doing in the note space with his fund and how he's working with investors. And so I really look forward to this session here. Joshua, welcome to the program, sir.
Thanks, Martin. I appreciate you having me on.
Yeah, no worries. And you're from the great state of Texas.
Yeah, that's where I live. I'm in Austin. One of the things I did want to mention that I got a copy of your book right here. I hope you don't mind me plugging you at all, but might help if I showed the front of it. But yeah, excellent book. Very good.
Thank you.
So I definitely recommend your listeners to grab a copy if they can.
No, I appreciate that. Yeah, and I know that you helped, with the review, and you provided a quote for the back of the book, and so that was real meaningful to myself. And you're in good company, right? Steve Lloyd also on there.
Yeah.
So
I didn't write it though. I know how hard it is, or time consuming it is to write one. So it's I think you did a great job.
Thank you. I think if you ever really truly want to know, like, who has built time in their life, find someone who's written a book, and they have. So there's no way I could, I could be working a corporate job and doing a side hustle and notes and writing books and stuff. So it's really a full-time commitment, as you know.
Yeah.
So you have a book coming up, right? In fall. Are we gonna do you want to put that out there at this point, or you just like to keep it in the dark for now?
No, I appreciate you asking. So currently I've got my the book that you mentioned, Paper Profits, which I would like to, at the end of this, give away to your listeners if they would like a free copy. My second book I'm working on, I'm roughly halfway through, and it's going to deal with note partials. So this is going to be something where, excuse me, I got some sound going on here. Let me shut this off so it doesn't interrupt. There we go. This is going to be something where folks are going to need a foundational knowledge about notes in general before they understand how to utilize partials, either as a buyer or a seller. But it should be out probably December of this year or January of the coming year. And it's really just going to be very similar to my Paper Profits book, where it's a step-by-step, what are partials, how to create them if you want to be the seller, how to maximize your portfolio if you're a seller by selling partials and really squeezing the last, every last drop of profit you can while still giving your buyers a great deal. And then showing it from the buyer's perspective too, where why, if I was a buyer, let's say, why would I even be interested in this? Why is this person selling? Am I at a disadvantage when I'm buying this? Answering those questions from both sides and showing you how to create them. So I'm excited about it. I think it'll be a very cool educational piece.
Yeah, absolutely. It's almost like you're writing on a topic that's a niche within the niche, right? You've already created loan modifications. You already have cash flow that's occurring. And now this is the extra play, right? This is when you go from being, having some level of wealth to becoming even wealthier.
It's a really cool thing. And I think it's a little bit more advanced. It's certainly not rocket science, but I think that it's the next step with a lot of folks who, once they do have a portfolio, are looking to absolutely maximize that. So there's some disadvantages to it as well, just like anything. but I find there's a lot more positive to it.
Yeah, no, that's great. I think, it's kind of an outdated thing, and I know we're kind of just talking about books right now,
Yeah.
but it's kind of an outdated model just to write a book that tells you how awesome notes are and how you're going to make $1 million in 6 months, and here's 20 case studies about how awesome I am. That's kind of that's kind of so yesterday right now.
Yeah.
So you want to get into more of the meat and potatoes, and giving kind
Sure.
of useful instruction in terms of what people can do as they're building their note businesses. And I think that's great you're doing it.
Yeah, absolutely. Is there some place that we'd like to start, specifically for your listeners?
Yeah. So let's talk about your how you got into notes.
Okay, so I got into notes a little over 6 years ago. And prior to that, I was a single family home investor, kind of a buy and hold type of guy. I did not start out with a bunch of money. So I was like most folks, have a normal day job. I happened to be a mortgage banker at the time. So my job was to kind of interface with the general public at the bank or at the lending institution and help them refinance their house or purchase a home and walk them through that whole process. So I've always liked finance and cash flow and things like that. It's always appealed to me. So I've always had that goal to set something up for myself in that fashion. Didn't really matter what it was. I wanted something that was repeatable. And to me, that was a big deal, not just a flash in the pan that maybe, in 1 year was a great opportunity, but something I could repeatedly do over time and develop real wealth for myself, my family, and be able to give back. So initially I looked at single family homes, had some rental properties. And then I actually had a conversation with a gentleman who was an investor at the time. And I told him, hey, I've saved up some money for another down payment for a property, and I can't find anything that makes any financial sense from like a cash flow perspective. And looking at the properties, not saying they're bad. I mean, I have rentals, and I'm sure you do too. A lot of folks do. They're great investments. But I looked at it and I'm like, this is going to take me forever to acquire enough properties to live on the cash flow, to be able to go out, pay my mortgage, get groceries, do all the things that we need to do. Everybody does. So while I'm talking to this guy, he had mentioned, well, you need to look at notes, buying mortgage notes. And because I was doing refis and things with folks at the bank at the time, I told him flat out, I said, I have no idea how, you make money on these things. They're giving them away at 3, 4, 5% interest rate. I don't have $400,000 to loan on 2 houses. How am I going to make money from this? So he's like, do some research, do some reading. And I dismissed him. I shouldn't have, but I dismissed it. And then a few months later, started reading about it and finally dug into the discounting aspect of notes and things like that. So I got very fortunate when I started. I actually bought my first performing note. It was a reperforming note. It was reperforming second for $18,000 or $19,000 with my IRA money. And I'm like, okay, I need to see how this thing works. And most of all, I want to see the transaction and I want to see those payments come in. Because it's nice to talk about them, but then nothing's like the kind of proof in the pudding, if you see it come in. So I did that and was really intrigued by it. And so I had a really good mentor. I can't remember, and I should know this, but I can't remember how we met or were introduced. But it's actually Bill McCafferty, who I credit a lot of my initial skill set to. He was very accommodating, very good guy, still is, a very good friend of mine. And he basically helped me buy my first couple non-performing notes. And again, with my own money, IRA money kind of deal, just kind of bootstrapping it. In those days, it was very easy to just go and pick 1 or 2 gems and just kind of see how it worked. So that's what I did. I didn't know any better, and Bill kind of guided me, and off we went. So this whole process of starting in that fashion with non-performers and things like that, I mean, it takes a lot of time. So it's not, even if you buy them today, it's going to be next year at best before you start seeing some money from that, as you know. So, a couple years later, I'm like, wow, this actually works. Bill's like, yeah, I told you. So we started doing more and more of that, and I brought friends and family. I had a business partner at the time, brought his money in. It was his IRA money too, and I showed him what I'm doing. He's like, yeah, let's try it out. So we had kind of the same success with that. We had a couple big home runs relative to the dollars that we had invested, and he's like, wow, this is, a big deal. So we continued doing that, and then branched off into joint ventures, which basically amounted to investors putting money in. We would go out and source the notes, do all that work, and then we'd split the profits after they were paid back. That's worked out really well, but there's some limitations to that. So the next step for us to scale it up into a business was really to create a note fund, which is a pooled investment fund that's regulated by the securities industry and things like that. So that's where we're at now. That was kind of my progression through. And, during that time, one of the things I would say I've really learned is that it's a very small community compared to maybe real estate, right? There's probably only a handful, a few thousand people that actually do this, that are players or have any, that make a business out of this. So networking with folks, developing those relationships, constantly moving that forward and giving value to these people is paramount. You're not going to cheat anyone and get away with it and be able to stay in the business. So,
no doubt. No doubt. Yeah, I couldn't agree with that more. We all love Bill McCafferty, and he's been a staple, within the industry, and has a great reputation. So let's talk about how Joshua moves from self-funding, because I like the progression you're talking about. You go from self-funding your first deal out of your IRA to now saying, I need to go the joint venture route, and then going from the joint venture route to the fund route. Explain why you made those moves.
Yeah. So in the beginning, my thinking was I can't accept, or I'm unwilling to accept, other investors' money until I've put my own money out there and proven the model, proven to myself that I have the skill set and kind of learned that. So, I have heard folks there where they'll kind of get the cart before the horse, where they'll go out and try to raise the money where they haven't really learned how to do this yet, which I think is dangerous. So for me, it was a natural progression where I felt more confident as I had used my own money at risk initially, went through that process. The next step from my own money to, let's say, a joint venture was really to expand it, make more money for everybody. So as far as the person like myself who was doing the joint venture, the motive is profit. Obviously, that's why people, you're in business to make money. But the other side, the investor, needs to make money as well. So our thinking with that was really to scale up, be able to go buy more notes, to benefit these folks who may not have the skill set, time, or inclination to do this on their own, and then also to help leverage our current connections, buyers and sellers and things like that. We weren't in a position at that point to really take it much farther, maybe as far as like a fund or something like a pooled asset or pooled fund. The reason for that is really a couple reasons. One, you don't really have the full skill set yet of running something like that. I mean, it's a fairly sophisticated operation if it's done correctly, and you need more people. You need partners. It's not something one person is going to do, in their basement. So it's kind of a natural progression for us. You certainly could jump if you felt you had the right connections and the skill set, et cetera. You certainly could jump just from doing it with your own money to write a fund or doing something else. But that was kind of the in-between process for us, was the joint ventures. And the reason to move from a joint venture to maybe, let's say, a fund is just being able to scale. With joint ventures, the way we have them set up, and there's a lot of ways people have these set up, but we actually had individual LLCs just to keep it nice and clean. So we'd have our investor in that, then with us. So you can imagine if you're doing that with only 50 or 100,000 here and there, which, you know, is still a lot of money, but you've got all these entities spread out. You've got tax filings and CPAs, and then all these things to keep track of. It starts to become a mess. So the next step from that is to clean it up and to do a centralized type of fund where more investors can get involved, and you have economies of scale too.
Now, when you did repeat transactions with your JV partners, did you open up a new LLC for each transaction, or did you just run it through the same LLC?
Well, we'd run it through the same LLC. So in other words, we have like XYZ LLC. They come in, they contribute the funds, then we go out and purchase. Once the deals are actually worked out, they get to choose how they want to get their money turned back to them. So if they just want to sell the note, they can. If it's a reperformer, if it's payoff, they just get paid. If they want to hold it, we just make sure that they get paid, and then we split, you know, monthly payments with them. So it's really up to them as long as it makes sense for everybody, because it is their money. So we would just keep it in the same LLC as long as it was the same people involved.
Mm.
Yeah, but we wouldn't bring a whole bunch of different entities, because then you're mixing funds, and not super comfortable with that.
And so it's almost like the JV is almost like the dating scene, it seems like, and then you start the fun. That's like the marriage, right? That's complete commitment. You have a whole structure in place. You're obligated, you know, with all the SEC and you know, everything's above board. Not to say the JVs weren't, but you had multiple JV partners, I'm sure. Now they can all come into the fund and invest, you know, through your structure.
Yeah, it is kind of a middle step, I would say. It's kind of an in-between, and it's not bad for a lot of investors. There's nothing wrong with it. It's certainly profitable if it's managed right. I think for us, it was a middle step, but I mean, you could stay at that step as a sponsor or someone who's going out and finding the deals for your investors. There's nothing wrong with that. Yeah.
Yeah. And what do you think, at what point, because we have a lot of newer note investors that are going to be listening, and I think a lot of newer note investors, they make a decision at some point. They say, well, you know, they kind of learn about note investing. They read your book. They kind of watch some webinars, and then they make a decision. They say, well, this is too complicated for me, but I get that there's profit. I get that there's, you know, there's money to be made here. So they invest with someone like you and your fund. Or they say, well, heck, I can do this myself, and, you know, let me get my hands dirty and figure this out. What do you think for those that want to figure this out for themselves? What are the pitfalls that they face? Where do you see most people stumble?
That's a good question. I would say that a lot of folks that come into it initially, and this was myself included, so this is not talking bad about anyone.
Yeah,
is getting overly excited about it, the opportunity, and then thinking, hey, I'm just going to do this and quit my job in a couple years. And the reason that doesn't work is because most folks are starting with a limited amount of money, and also the time it takes to learn the skill sets and to learn the business enough to become profitable and develop the relationships and all those things that go into it. I would say that if someone is coming in, maybe a wealthy individual coming in with a couple $1 million or more, you can certainly just go out and buy a bunch of reperforming notes and live off the cash flow. There's nothing stopping you from doing that. But from what I see, a lot of folks is just thinking they're going to come in, throw a bunch of money at it, or they're going to work this 2 hours a day and, you know, become successful. And I think it just takes a lot more persistence and determination, and above all, having the right daily habits than most of us want to acknowledge with anything. I mean, with absolutely anything. And this is no different.
Yeah. No, that's a real good point. Yeah, I kind of think about that question, and it's hard work, right? And it takes discipline, and it takes a routine, forming a routine. We often kind of look at things through the prism of, like, you know, how we progressed or how it affects us. what I think is often kind of overlooked is how you escalated the value that you delivered to the sellers that you enhanced your relationship with over the course of time. So you self-funded, you bought from probably one other note investor, a peer that just sold you one note. And then you move to the JV model. So now you start going upstream with some of the sellers and start kind of getting the lay of the land. And now you have a fund. So it's really your duty, right? It's your mission now to know all the players, have relationships with all of them, be in the mix, be at the right conferences, and so to speak. So tell me about how some of the things you've done that have brought value to the industry, that has brought value to the sellers you interact with.
That's a good question. I don't think I've ever had anybody ask that. And it's an important one. So as far as adding value to everyday investors, the people we talk to, I've always made it a point, me and my partners have, just to provide value in the way of education. So you're never twisting someone's arm. It's always about just educating on what you're doing and giving as much information as you can without giving away, any kind of secret sauce or whatever that may be, but just being free with the information from day one. And I think the tendency that we may have initially starting out is to hold things back and be real secretive with stuff. And if you want to interface with colleagues and investors, that's the opposite of what you need to be doing. So I think adding value that's one way to add value in every kind of interaction that you have, is just being free with information and helpful. The second thing with regards to the dynamic of buyers and sellers is, as you start purchasing one note or two notes, and then you start doing more and more, like you've had a lot of experience with, basically you're looking at, I wouldn't say more demanding sellers, but sellers that have more options. So this means that you need to be easy to work with for the most part. So you don't want to don't want to roll over on things and be a lay down, but you want to put yourself in their shoes, meaning if they're selling a bunch of loans, you need to kind of put yourself in their shoes and say, what kind of person would I want to be selling to? Would I want to be selling to someone who's a pain in the butt, who just keeps nickel and diming me and coming back and grinding me over pennies? Or would I want to sell someone who maybe at a slightly lower price or market price, but that I enjoy working with, who I know has the money, who I know is not going to just hassle me? So being easy to work with is number one, and then also being upfront. If you're not interested in something, if somebody sends you something, a tape, or you've agreed to look at something, respond to them. Even if it's total garbage, respond to them and let them know, hey, this is out of my wheelhouse. I'm not interested in this. That kind of thing will go a long way over time. It's not instant. It's going to take a while to develop those relationships. And then as you move up, obviously, like in today's market, you're going to need the money. So having a seat at the table, you're going to need $500,000 or $1 million or more to get kind of where a lot of people want to be, to be able to go and buy the assets. So not to say that you can't get singles or ones or twos, but it helps to kind of combine forces in a lot of cases in today's market.
No, that's
be of value to the seller.
Like you touched on, the easy days are gone. They're done. I mean, the easy days were years past. You could go, you get a tape of 100 notes, and it didn't matter if you bought two, because everything was loan level. It didn't matter if you bought two off of them or you bought 10. And if you're like me, you're probably still kicking yourself for leaving so many good notes on the table because you thought that's how it always was going to be. But in today's market, like you said, you have to be very delicate with the relationships with the sellers, and because what you're going to get is you're going to get large opportunities. In a lot of cases, it's all or nothing, it's, there's going to be a lot that are on the junior lien side. There's going to be a lot that are going to be unsecured that you won't know about till you do your appropriate due diligence. And so now you're coming back, and in some cases you're telling a seller, who may not know about all the unsecured on their pool, hey, 25% of this is junk. It's unsecured. It's been swiped. It's been stripped. Is foreclosed on, whatever the case.
And they love that. They love to hear that.
Yeah. They love to hear it. Well, yeah. And now what's their first thought? Their first thought, well, let me go around and see who I can pawn this off to.
Yeah. Their first thought is, screw this guy. Yeah.
Yeah.
Somebody else, which you can't blame them for, they're just trying to make money as well. So,
and in some cases, they bought those notes that, not doing all their due diligence because they were flipping the paper. That was their intention. So they paid for a secured note, and now they're having to grapple with selling it at an unsecured price, and they're kind of figuring that whole thing out and seeing what they can get away with in some cases, but in some cases they just don't know. And so you have to come across in a very professional, delicate manner.
Yeah. Absolutely. And they may have been kind of in the same situation or put in the same position where it was an all or nothing trade for them, right? They may have been forced to take everything. And so they didn't have a choice to kind of pick through the gems or whatever. So, and they're passing that along, to the buyers.
So let me ask you a question, because I don't have a fund. So I don't operate that way. However, what do you prefer? Do you prefer investors that are within the industry, or investors that are outside of the industry and don't really know about the industry? I have an opinion, but I want to understand yours.
So we like educated investors. So someone who has no understanding of notes, who may not have read my book or has no exposure to the note industry, I'm very hesitant of. And the reason for that is I think investors should always do their due diligence, and they should always at least moderately understand what they're putting their money in. In a lot of cases, this is IRA money or savings that is going to go for, helping their family in the future. So it's a big deal for them to understand, at least at a basic level, some of the fundamentals. It just depends. I don't mind folks that are actually in the industry. It doesn't matter to us one way or the other. I think what matters is having that level of education, to where they understand what they're getting into, and, that it makes sense to them.
So let me ask you this, and this is, I may be unpopular with this thought, but I want to run it by you. And
sure.
Well, I think everyone in the industry should be running skip trace on everyone else that they're doing business with. whether they're getting training, whether they're getting, whether they're strategic partners on it, trade buy partners, whether they're, whatever the case. And I'm not saying like full blown comprehensive, but criminal check, that kind of thing. Make sure that, they're not serial BK filers or whatever. It's not to say that, someone does file BK because they had a legitimate issue, circumstance in life, but you know what I'm talking about, like a serial filer kind of thing. But I think that's something that would be important. What's your thought on that?
I can't argue with that. And the reasoning is very sound. And if someone is investing money, especially a substantial amount of money, with someone that they may be familiar with, but maybe they haven't met in person, I think there's something wrong with that. I would ask for permission first, maybe. I don't know if you necessarily need to, but there would be red flags if somebody started throwing up and saying, well, I don't want you to do this or that. So yeah, I don't have any problem with that. I wouldn't think that anybody legitimate would.
Yeah. So let me ask you this. In terms of the fund, you have multiple funds, right? So I even know, and I'm sure you know too, there's some people on the newer side that still go the fund route, because they maybe they think that if they open up a fund, it'll expose them to more inventory, it'll expose them, to more investors, whatever the case. So they feel like that's the magnet, that's the draw. But to your point, you should do the fund you should grow into that fund through maturity and through experience, and that way that'll ensure success within the fund. Tell me about some of the things that you do within your fund and you're not giving specifics in terms of terms or whatever, but what are some of the philosophies or the customer service practices you do within your fund that makes it unique and special?
That's a good question. So what I would say is that our fund does have a lot of the common characteristics of other funds. So I'll be very upfront with you on that. I wouldn't say it's overly special or overly unique. What we do focus on with regards to our fund is keeping the borrower in the home. There's a couple reasons for that. I know a lot of folks say that, like that's the mission, this, that, and the other. A lot of that is business oriented, but also from a human perspective, because a lot of these folks who have this debt have been in their home for a decade or more. So we're not looking to displace folks. We're looking to work something out with them that makes sense. And I think a lot of funds are doing the same thing. So in that perspective, we're not unique by any stretch. And it works out very nicely because that's actually the most profitable solution in most cases as well. So when and if you can get that, which is most of the time, that's really the focus. So I would say that's one of the things that from, I don't even know if I could call it a moral perspective, but whatever you want to call it, is kind of our win-win, where we're looking to modify or help the borrower out, settle the debt in some cases. Let's see what else is unique.
So you don't want to be a long-distance landlord.
There are some, having rental properties is good, but long-distance landlord really just sucks. Not to say that there's not value in it at some point, but again, I think, like you've talked about, and a lot of times, is that it's going to depend a lot on what your goals are. And some people want to acquire a bunch of properties, and then other people want to quit their job or have $10,000 a month in cash flow. For some reason, 10,000 seems to be the magic number. Everybody you ask, it's $10,000. Like, that's okay. But to get that cash flow, a lot of times it's not rental properties. Or if it is through rental properties, it has to be a ton of them. I mean, you just have to be a miracle worker. So notes just happen to be a better vehicle for that, but they're not great for other things, as like appreciation and, building equity, because they actually go down in value as they're paid off, things like that.
Yeah. And then interest write-off and other tax advantages. Yeah. I kind of, like you said, a lot of note investors have real estate holdings as well. And I think that's the way to go is you need that balanced approach. You need the tax savings that real estate gives you, as well as the profitability that the notes give you.
It pairs really nicely because there's a lot of things that real estate has that notes don't have. The deductions just for even owning it, whether you took a loss or not in a lot of cases, appreciation if that happens. And even if there's no appreciation, if you're long-term, looking at the long-term horizon, if you have a nice house and the renter's paying your mortgage, even if it's break even, eventually someday you're going to own the house outright. And then if you rent it, all that's going to be profit, and the house will probably have doubled in value. So there's a lot of good things about real estate. It's just, in a lot of cases, the cash flow perspective is difficult to feed yourself while you're waiting that 20 years.
Mm-hmm. Yeah. And not to mention, dealing with commercial. And I know there's a bunch of these zero money down guys and gals that are out there, you can get into a property with zero money down. And, but, in most cases, you're putting down a 20% chunk. And and that can dry the well up pretty quickly. So
yeah, absolutely.
So let me ask you, you with your fund, you took on a partner. Why take on a partner?
That's another good question. So my thing with partners, and we're all learning, so I'm learning as we go as well. Partners should complement, in my opinion, missing skill sets that you don't have. So they should bring something to the table, not because they're a friend, not because you like them, but because they have something that you need, and vice versa, right? You have something they need, whether that's a skill set, money, resources, some other avenue that will complement what you're doing or the actual venture. So for me, I have two other partners. One is Bob Malecki, which a lot of folks know, and then another gentleman's name is Scott Ruzich. So my partners complement skills or abilities that I lack, that I'm either not good at, I don't have the resources for, like I don't have the network, or I just don't have the connections that they have in some area that is valuable to our operation. And I think most partnerships are like that. Maybe folks don't realize that, but that's really why you bring a partner in, is to, so everyone gains something, right?
Yeah. And, you know, it's interesting because you and I talked at IMN about having performance metrics in place with partnerships and how that's, so tell me about, because what's the old school, right? The old school is you got three people in a room, 33, 33, 33, you know, everyone wins. But what happens, you might have someone that only does this on a part-time level and someone else that's, you know, doing it 90 hours a week or whatever. So what are your thoughts on performance-based metrics in terms of partnerships?
It's a good question. I think that no matter how excited or dedicated or great things seem at the outset, there should be some level of compensation for each partner based on continued performance. Now that could be, you know, set however the partners agree on, and it's going to depend on the business model and things like that. But just to make sure that you don't have somebody come in, great intentions, and then one or two partners doing all the work, or there's a lopsided effect to where you're really, this other partner becomes a liability. It becomes something that is a struggle. Like, man, I wish we had somebody that was like doing their job, you know, once you're 2 or 3 years into this thing. So having performance metrics where, yeah, they're still a partner, even if they suck, but maybe a large part of their compensation is based on doing X, Y, and Z. And that could be renegotiated over time if that changes, that need changes what they're doing. But at least everybody needs to be on the same page with that. I think that would be probably the best way to set it up. It's going to be a tough conversation early on, but it's probably one you need to have. Yeah.
Yeah. What are the three things that a new note investor needs to do to get their business or their note investing, you know, profession off the ground?
It's going to depend on where they're starting from. So if they have purchased notes before, they're going to need to figure out where they're going to get the money and develop a consistent source for that. Meaning, if they're raising it from investors, they need to be interfacing with investors, educating. They need to be marketing to them, not selling to them, but educating to them, developing those relationships. They need to be at the same time simultaneously developing that same network with sellers and buyers. So when they have product for sale, they can have people to sell it to that they trust, and then also people to buy it from when it's ready or when it's available in the marketplace. And then the third, I don't know about the third.
If you would have asked me the same question, if you would have asked me that question a few years ago, I probably would have said they need to know their why, they need to have passion, they need to get formal education. But if you ask me today, I think the first thing someone needs to do is develop a time commitment. Because I think I've seen people that come in with a why, and Michael Solis says passion. He's on here. He said passion, but thanks, Mike. And I've seen people come in with the passion, with the why. They pay for, get the formal education, or they self-educate or whatever, but they never put the time commitment in place. And by time commitment, I'm going to give you an example. I am currently working on an opportunity with, and I'll put his name out there. Michael knows him well. Sean Munoz, who is my second protege. We're working on something.
Yeah, Sean's awesome. I
Oh
like
yeah,
Sean.
you know Sean. You've dealt with him too and everything else. And my man sends me something at 1:30 in the morning. So he's running through things, and that's the Sean that I knew from day one. When there's something pops up, he is there till late at night, pounding it and making sure everything's in line, making sure all the due diligence is covered, et cetera, et cetera. And that's right there. I mean, tells me everything about his ability to succeed, about his about how he will succeed. And
yeah, absolutely. He's willing to go the extra mile for it. Yeah.
Yeah. So time commitment's a big thing. So let me ask you this: what have you done in today's age where pricing has just gone out through the roof? It's at the nosebleed levels. What are you doing to offset price hikes out there? So
there's not a whole lot you can do with regards to, beating someone down on price, because price is obviously a function of supply and demand in the marketplace. So one of the things that we've tried to do and are still working to do is to become more valuable to sellers. So when there is a large opportunity, instead of coming in and trying to say, hey, I'll take a little bit of it, well, can we help this seller make his life easier by coming in and taking most or all of it off his hands? Whether some of that's assets that we don't want or not, that's kind of one of the things, becoming more valuable to them. And then as far as pricing is always negotiable. You should always have that conversation as far as expectations. But additional due diligence will help alleviate some pricing concerns, meaning going into, if you're just looking at the basics, hey, how much equity is this thing? How much is all this other stuff? You'll miss a lot of gems that are there. So really digging in, if you have a genuine opportunity to purchase, really digging in, I think, helps alleviate some pricing concerns, or at least sets a ceiling on the max you can pay for this, right? Because I'm not necessarily so concerned with how many cents per dollar or UPV we're paying. I mean, it's obviously a function of what we're looking at, but I'm not like hung up on, oh God, this is 45 cents on the dollar, 50 cents on the dollar. What I'm looking at is there actual profit here? How safe is this for us? Is there still a deal here, a legitimate deal that we're not cutting so thin that there's not enough meat on the bone? And if there is, we'll still buy it. So having that flexibility to take some stuff that you normally wouldn't take to help the seller out, if there's enough there for you, I think is a good strategy to deal with today's pricing. If you get hung up on the pricing and hung up on, just cents on the dollar, you kind of price yourself out of a lot of still really good deals. I mean, we're still buying stuff that's, that most people that is at 50 cents on the dollar plus, and it's still just fine.
Yeah. And you're looking, so in terms of profitability, you're looking at cash on cash?
So what we're looking at, if it's a performer, like a reperformer, we buy a lot of those.
Okay.
If it's a reperformer, we're looking at yield. We're doing a yield calculation with like time value type software. And then if it is a non-performer, we're just looking at, hey, is there a realistic expectation of, is there equity? If there's not, a lot of times we'll buy it. It just depends on the situation. And then is there a legitimate play here to at least double your money or better on something, of that with this purchase price, counting legal, counting the time we have to wait, to kind of have this whole thing hashed out.
And so when you're buying reperformers and you're looking at the yield, you're also, I assume, keeping in mind what you're paying your investors back. You're looking at a spread between that for your profitability and to cover your expenses for the fund. And
so
go ahead.
I didn't mean to interrupt you. Sorry.
No, that's all. I was done.
Okay. Yeah, so it depends where the money's coming from. If it's your money or, your personal portfolio or something like that where you don't have a cost to the funds, then it's just a straight yield. Hey, do I like this note? Is it something I want to buy and hold? If you have investors and you're paying them a rate of return of some kind, you got to factor that in as well, I think, for sure, because that money is costing you money just to hold it and invest it. So whatever you're investing in needs to be producing more than you're paying your investors. So yeah, on reperformers, we have a minimum benchmark where, we have a certain yield that we need to hit in order to accept those into the fund. Otherwise, it's just not profitable for, the investors and the fund itself.
Got it. And I like how you have several facets of the fund. You'll get involved with reperformers. You do you buy first, you buy second. I assume no CFDs in the fund, or?
We have not. Yeah, I'm not a huge fan. I know there's folks that have made a lot of money and continue to with CFDs. There's a lot that I'll be the first to admit I don't know about them. I have a general understanding of them, but there's a lot of nuance that I don't fully understand at a state level for certain restrictions and things. We have not, and we're not going to, at least for the present time, purchase CFDs. Yeah.
Yeah, but still, you have you have a good amount of diversity just between reperformers first and seconds. So again, that speaks to being easy to work with, right? I mean, the last thing a seller wants to say is, "I'm giving you a blended pool." And you're like, oh, can you pull out the reperformers? Oh, can you pull out the first? I only buy in these states for seconds, et cetera, et cetera. And then you just become like, a pain in the neck.
Yeah, and then that's kind of probably the last time they're going to offer something to you, or close to the last time. But yeah, I agree. Being flexible and looking for that extra profit, looking for other ways, because we have to grow as investors. If it's a legitimate business, we have to grow as the market changes and as supply and demand changes. Otherwise, it's just not going to work long term. So I think having different tools in your tool belt, like buying reperformers, buying first and seconds, buying non-performers, even partials, looking at notes with partials. I buy partials all the time where I buy the full note, turn around and sell the partial and keep half of it, and get the money back that I have in it. So I have no money in the deal. So I do that all the time. And so that's why a lot of times I can pay almost full price for reperformers in a lot of cases. Nobody else wants them, but they're still great deals.
I can't wait till your book comes out, because that's an area I need to grow in. So I'm really looking forward.
It's really cool, man. I gotta tell you, I'd be happy to share whatever you want.
Yeah. Let me. I don't know how much I can contribute to this subject, but I'd love to be a part of it. If you need any help in any way, let me know. We have a question here, Josh.
Absolutely.
So Michael Solis asked, does he charge a management fee during the workouts, or does he wait until the investor gets paid first before he starts dipping?
So is this like a joint venture scenario?
Let me read the question again here so I make sure I understand it. Do you charge a management fee during the workouts, or do you wait till the investor gets paid first before you start dipping? Mike, are you talking about when he was JV? And I don't know that he's doing that as much now, but just let me know on that. Yeah, so I guess we can talk about JV. I mean, do you mind talking about JV? Like, what's the normal?
No,
you do a gross split and then a net split after liquidation. What was the setup?
So what seems to be popular, and I didn't invent this. I mean, I basically just saw this, created from other folks and copied the model. Was somebody will put the funds up, the investor. We have some sort of structure or entity. In our case, it is an LLC. They'll put up, let's call it $100 grand. We'll go out and I'll find the source assets for them, bring it to them, price it, do all the negotiation, and then they'll have to approve everything because it's their money. So I can't go out and spend money, their money without their approval. We'll use our resources, our network to work the assets to resolution. And then at that time, they get paid their original principal investment back per asset. So we break it down per asset. So as each asset gets resolved, we handle that individually as its own deal. They get compensated back the original investment, and then anything above that is split 50-50. So anything net profit. Yeah. So that's how we've been doing it in the past, and it's worked out well.
Are you JVing much now, or?
So I would be open to JVs now. Some of the issues that we've run into is just scalability. A lot of folks, $50 or $60 or $70,000 doesn't go as far as it used to. So it makes more sense from our perspective and just from a time perspective to have more money. So if somebody came to us and said, hey, we have $300,000, $400,000, $500,000 and we want to do a JV, we would probably entertain that if it was the right fit. But right now, most of our focus is just on the fund and other things. Yeah.
Yeah, that makes sense. It's a whole new day out there. Mike's asking about the JV. So yeah, appreciate that question.
Yeah, thanks, Mike. No, so we don't charge anything. There's nothing that's being charged during that period of time. The loans get worked out, and then only at resolution is when everybody gets paid and the investor gets paid back first. So obviously there's legal fees and things like that that are being paid during that time, servicing fees, all that stuff. But the sponsor or the person kind of, going out and doing this is not charging a fee initially.
Yeah, I know Michael's one of the masters of understanding his value and never
I know all about him.
Himself.
He's awesome.
What's that?
Yeah, I know all about him. He's a good guy. Yeah. I see his videos and all that on Facebook. Yeah.
Yeah. Another dude that's going to be around, in 5 years, 10 years, and so on, just like yourself. So I think that's awesome. So tell me about, you mentioned daily rituals are important to have in place. What are some daily rituals that you have that kind of help you keep going throughout the day?
Yeah, so I'm a big believer in habits and rituals. And for some people, they might think, well, it keeps your day monotonous and you're like a robot. In some cases, I like that, having predictability. So I think a lot of life, and not just this business, but just life in general, success comes down to what we do every day, what we do when we get up, what we do habitually. And whether our intentions are good doesn't really matter. It's what we're doing daily produces who we are down the road. So somebody that's doing, reading every morning is going to be very different in 10 years from somebody who turns on CNN every morning and smokes a cigarette. It's just, their life is going to work out differently. And it's not because they're any smarter, they're just doing something differently daily. So some of the stuff that I've developed over time for me, and it's probably not a good fit for everybody, is in the morning I do usually get up, I don't jump right into work. I'll have a cup of coffee. I usually do meditate for about 20 minutes. I've been doing that for about 10 years. I use just a headset with like a binaural beats kind of thing, kind of makes you zone out. You just do that for a little bit, finish my coffee, read for about half an hour, write down what I'm thankful for, or, maybe some goals or something like that, and then kind of start my day. So I'm like kind of setting myself up to kind of be on an even keel and feel all right about things before just diving into email or diving into, phone calls or anything else, which makes you feel real scattered. So I've done that, and that's helped me more than almost anything. Just that real simple, doing that every day. And then exercising has been a big deal for me. I exercised since I was in high school, but for me, it's made all the difference. It helps break up my day. It helps you just feel better. You just feel better, and you've got more energy to do your job, more energy to spend with your family, to contribute to things, to be with your friends, all those things that I think we all value at some level. So I know it's real simple, but that's kind of what my routine, at least in the morning, consists of.
No, that's terrific. Well, Joshua Andrews, everyone. Josh, if you could leave your contact information in the comment section on this thread here, under the video when we get off here, so that way people can contact you. Paper Profits is a really high-ranking, popular book on Amazon. It's one of the first books I read.
It is the highest-ranking book
The highest
Anyway, I
rank.
got a copy of it here.
Awesome.
If you guys would like, I'd be happy to give everybody a free copy.
Okay.
I'll leave my contact information. Yeah. And then also, if you don't have it already, you should be getting Martin's book, which is a fantastic read as well. So.
Oh yeah, yeah. I put a lot of time, as you know, as you did for yours. So.
I know you did. Yeah, you did a great job.
Everyone, thank you so much for joining us. Be safe, be good, have a great weekend, be prosperous, and God bless.
All right. Thanks, Martin.
Yep.
All right. Take care.